Goldman with you here on your hometown station, AM 1220 KHTS. In the studio, we have Melissa Lampert, our very own Melissa, KHTS Features Director, Lou Esben, attorney at law, and our realtor specialist, Richard Sherman. And we're talking about the hidden mortgage crisis, as we can call it, or the second mortgage crisis attached to seconds, the fallout from the housing crisis we all experienced some 8, 9, 10 years ago as it was weaving its way through the entire country and certainly impacting Santa Clarita quite significantly. And now we're seeing fallout from that and happening in real time with real people, with our neighbors here in Santa Clarita. As I said before the break, it's disheartening as to what's happening, and hopefully we can talk through some of the solutions today and at least lead people in a direction that will become helpful, as we've been doing with a number of stories through the last few months on the radio station and through our hometown station website. We were talking about Chapter 7 and Chapter 13. For those who just tuned in, we're talking about how you have a first and then a second on your home, and quite often the amount of equity in the home doesn't even equal the equity in the first, and now the second is also sitting there. First of all, let's backtrack. Lou, why don't you explain the difference between Chapter 13 and Chapter 7?
Okay, so let's talk about them in the context of a homeowner, because that's what we're talking about here. So in a Chapter 7, if a homeowner is in arrears on their home, okay, a Chapter 7 will not provide them protection against foreclosure.
And just to backtrack for those who don't understand this, we're talking about bankruptcy, pulling a bankruptcy and a personal bankruptcy. Chapter 7, Chapter 13 are for personal bankruptcies, not for businesses.
Correct,
Yeah,
correct.
exactly.
So you tee this up. You have a homeowner who is in arrear on their mortgage, and they're going to get foreclosed. The 3 months of the notice of default is already run. They probably got a notice of sale tacked to their door. They go to Rich. Rich says, you have 20 days to deal with this. Go see Lou. So now they sit in front of me, and I say Chapter 7 or Chapter 13. If they want to save their home, Chapter 7 is not the vehicle, because Chapter 7's a trustee is appointed whose purpose is to liquidate the property, if any, and sell it off so that they can pay creditors. In a Chapter 7, you do not have the opportunity to reorganize. Okay, it's you're in, you're out. You know, whatever you make your payments on, whatever you want to keep, your cars, your boats, everything else, but your house, you can do a Chapter 7, but you're going to lose your home. If you're current on your house, you can follow Chapter 7, but just understand that you have to keep making payments on your secured creditors, otherwise you're going to lose things. So you can lose even though we filed the Chapter 7, and you have to keep making the payments on the first in your house, keep making payments on the second on your house, and if you want to keep your cars, your boats, your toys, and all that are secured, you have to make all your payments. That's Chapter 7 in a nutshell, very quick. Chapter 13, on the other hand, same scenario, couples in arrears, they come in, Chapter 13, they have a first, they have a second. In a Chapter 13, you take a look at your income, your expenses, and you make Chapter 13 plan payments that are used to cure the arrears on the first. Okay? During the Great Recession, we were doing Chapter 13s, valuing the properties. Rich was instrumental in a lot of that. And we would then value the property. They'd continue making payments on the first. They'd make plan payments to the Chapter 13 trustee, who would use those payments and to pay those to the lender, so the loan became current. And the second, if the property was worth less than the amount owing on the first, the second ultimately would get wiped out in the discharge. Okay. That's, in essence, the difference between Chapter 7 and Chapter 13. Pretty quick, huh?
Yeah, for those of you who weren't taking notes, with the Chapter 7, it does not discharge the second. It strips it from you, but it doesn't strip it from the house.
Right. So in a bankruptcy case, the individual gets a discharge, but the real property does not. So the terminology literally in case law is the second rides through, or the lien rides through. Okay? So you can file a Chapter 7, you're not in arrears on the first, file a Chapter 7, and you've been told, oh, just make the payments on the first, don't worry about the second. Well, your personal obligation on the second has been discharged, but the property is still liable for it. And that's where we get to where we are today.
Exactly. Now, with the Chapter 13, if the first over-encumbers the property, you go through all that, and it does kill off the second. But we call them zombie seconds, and that's why there's such an issue. A really good way to illustrate this is a couple of years ago, I was told by a senior official at one of the big banks, I was told if I could have called through the phone and killed him, I would have. But he said his exact words to me, where I'll never forget as long as I live. We are sitting on over $1 billion, we being the bank he works for, we're sitting on over $1 billion of uncollectible seconds right now, what we consider bad debt. We're not going to do anything with it. We're just going to sit on it because, this is like 2009, because there's no point in going after houses or going after people who have no equity. So we are going to wait 7 to 10 years, so now, and then what we're going to do is we're going to go after people. Even though we know California is a non-deficiency state, even though we know we cannot collect on these debts legally, we're going to send out mailers and threaten lawsuits to all these various people that we've got, because if even a small percentage of them get scared enough and don't seek competent counsel and start cutting us checks, what's it cost us? Some money in stamps? Sounds like a profitable program to me. Now, the fact that it's immoral, unethical, and completely heartless was not part of this man's thinking. This was just a business decision. These are guys, I describe them as these bankers, this sort of banker, I describe as the sort who haven't seen the last reel of Wall Street. They all look like they comb their hair with buttered toast. They all have those thick little glasses. They all wear the shirts with the white collars and the white cuffs. And they all think Gordon Gekko is a character that they aspire to because they don't understand the third reel of that film. And they pat themselves on the back as being smarter than, because they figured out a way to turn what was bad debt at a bank into something that was collectible. Now, the fact that it was dishonest and immoral doesn't enter into their thinking.
But doesn't mean it's illegal.
Exactly. Well, that's their point. They find a way to kind of snake their way through it, and they think they're clever for having done so. And at the higher levels, what you see is the banks figured out a long time ago that it was more profitable and made more sense for them to not just exist in the world of lobbying, but to also give lots of money to political campaigns on both sides. It doesn't matter which side of the aisle, because that way they're covered. What they want is access, so that these loopholes continue to exist. It is ridiculous on its face that a Chapter 7, which can discharge all your other debts, cannot touch a second.
Well, and the Supreme Court, or the Court of Appeals, recently said that you cannot strip away a second in a Chapter 7. That's now settled law. I think it was actually a U.S. Supreme Court case. It's settled law.
I mean, to the layperson, that just makes no sense. If I file a bankruptcy, if I tell the world I am insolvent, shouldn't that mean I am? But no, this debt continues to exist. And what's even worse is they will take these debts and they will sell them off and sell them off and sell them off. They're supposed to notice the client, but they don't. But a client can't prove a negative. You can't say, I never got this notice. In many cases that we get, clients will come in and they'll say, look, I just got this notice of sale posted on my house, or this notice of default posted on my house. And I've never even heard of this company before. And they say I owe them $100,000, $200,000, $300,000. I've never even heard of them. I had one client call me and said, this is a company in Miami. I've never been to Miami. So you don't have to be there to have this happen. It just got bounced around, and this is where it landed with. And these guys who now own the debt figure, well, hey, when your house is only worth $300,000, we had no interest in this debt. But we paid next to nothing for this debt. Now your house is worth $600,000, so now we're going to get real interested. And it's awful. It's absolutely awful.
And the statute of limitations on collection a note secured by a mortgage could be up to 30 years.
Yeah.
Wow, 30 years. Yeah, so this is not going away.
It's insane.
It's not going away.
And as you said, the seconds, even though they were in this dormant state, are still accruing interest.
Well, that's why we call them zombies, because people think they were dead. I filed bankruptcy, or I just got a charge off in the mail, whatever. I thought this was dead. I was done. Mm-hmm. I only had to contend with the first. I got the first settled. I did a modification. I paid it, whatever. I got it sorted out, and I'm finally reaching the end of this horrible economic tunnel. I'm finally getting to the end of it. And that turns out, surprise, not only do you still owe that initial debt, but the thing is, it continued to accrue interest and go crazy. And now you owe, twice, 3 times what that debt was. And oh, by the way, if you don't find a way to pay that, and they usually want a lump sum up front as part of the deal, you're going to lose your house.
And that's why we were really encouraging people to do Chapter 13s who had seconds.
Absolutely.
And strip away the seconds. Because, California goes through a 7 to 9 year real estate cycle. So we knew that by the time they got through the Chapter 13 in 5 years, the property would be worth at least as much as was owing on the first, if not more. And so they'd come out of the 13 as would be historically proven, with equity in their homes and without the seconds.
And really having a second chance, which is what...
Which is the point, of course.
Oh, yeah.
Of course.
So clients of mine who listen to me, and the referrals from Rich, who went through the 13, some of them are sitting on $250,000 of equity on their homes.
Yeah.
Okay? They come in at 13, they don't have the debt, they don't have the second, and they're sitting on equity, and their lives have turned around.
Your hometown station, AM 1220 KHTS. Carl Goldman here in the studio along with Richard Sherman, Lou Espen, attorney at law, Richard, the real estate expert, Melissa Lampert, our staff KHTS features director. And Melissa, you've done a number of stories. We talked about one. What other one comes to mind of one of the families you covered?
Yeah, so we also, we actually visited a family or a man that lives in Fraser Park, which is not too far from here. And he, I believe, Rich, he was also facing like a loan modification.
Yeah, well, in his case, it started off as a loan modification. There was really no practical way to do that. Frankly, the house is in such bad shape. It was not one of these things that I hate to say it, but it really wasn't worth saving at that point. The debt load on the house was so high, his income was so low, that there was really no practical way to do that. So in his case, the best option was to do a short sale because that limits his future liabilities and cleans up a lot of this stuff. And in his case, and it would happen to be the same bank as the previous one with the U family, as it happened, just bad luck for this fellow, they said, no, we're not going to do a short sale. We'd rather foreclose. And we said, well, that's ridiculous. And we had to fight with them tooth and nail to get them to even acknowledge they should do a short sale.
Just let me understand this. Why would they want to foreclose if the house didn't really have that much equity?
Because that's what their board of directors decided is how all loans, regardless of the circumstance, regardless of the state they appear in or what else is going on, that is the way they should handle it. What typically happens with these banks is a board of directors, however large or small, makes these decisions. And these are people generally who've never even flown commercial in their lives, let alone paid a mortgage. So they have no concept. But they say these are the rules because basically what they're saying is we're not going to spend the money to hire decent people. We don't trust the people we've hired. So these are the rules. This is the little box that you will exist in. And if there's anything outside that box, we don't care how logical it is. You're going to exist in our box and that's it.
And California law on short sales do not require the lender to accept the terms of a short sale.
Yep.
If they accept the terms of the short sale, it falls within the what they refer to as the anti-deficiency statute. They accept the terms of the short sale. They cannot collect anything over and above the amounts that were paid in the short sale.
Now, in most cases, it is in the bank's financial interest. I mean, every case is different, but in the vast majority of cases, it is in the bank's financial interest to do a short sale. They will get more money for the property to satisfy the debt. They will take less of a loss, and it will happen much, much faster. And we all know that's common, knowledge across the industry. Even the people at the banks typically know that. But if they're told they're not allowed, they're not allowed. And in that particular case, what suddenly changed their mind, which also changed Shells Point's mind in the previous example, is because they got exposure. And these companies really only are able to get away with what they're able to get away with if the client is uninformed and if they are allowed to exist in the shadows. And the minute you drag people like this into the light, the immediate, we didn't say that. What if I don't know if my underling wasn't paying attention? I'll have to fire that guy. I don't know what time. And all of a sudden, it's somebody else's fault. It's very much the dog ate my homework every single time. You talk to Melissa; she's talked to these people as well when she calls them, because obviously the reaction I get is they tell me to drop dead, and then when they get a call from the press, it's I didn't say that. Oh well, no, it's good.
Right, that's what I said. The exposure is coming from KHTS and Melissa.
Yeah, and that was me making those phone calls and saying, "This is the situation. This is what the homeowners are claiming. This is what their realtor is saying. This is how I understand it." And then I'm asking them, what's your position on this? What's your side? What's your comment? And they just go into panic mode and have to figure out. They have to figure out like what their records are showing. They have to figure out what's been said to the homeowner, what's been said to Rich, and then they have to decide what they want to tell me. And it's just a mess because clearly things aren't adding up. And so by calling attention to that, they're forced to figure out, okay, how are we going to justify this? And what are we going to say to the public to make this look better than it is?
Well, and I refer to them as vulture capitalists, and one of the reasons that I call them that is because some of them have the business model that the reason they foreclose is because their business model is to take back the property. During the foreclosure crisis, BlackRock became one of the largest owners of residential real property in the United States. Why? Because they foreclosed. Well, a lot of those opportunities have gone away, but the business model is still out there, and it's being used by these vulture capitalists with the seconds, who figure a certain percentage of the time they can actually recover real property. They'll kick out the homeowner, they'll pay some money to do some remodeling and renovating, and they'll turn around and sell the home for more than they would have gotten in a short sale. And that's their business model. It's a business model.
Also, in an accelerating market, they know the longer that they take, the more the property worth at the end run.
They may rent it, they may Airbnb it. There's a lot of different things they can do once they get the real property in hand.
But for the listeners out there, think about what Lou just said there. You're talking about a company that was one of, if not the single largest residential property owners in the United States. and you've never heard of them.
BlackRock.
Yeah, well, we know who they are, but I'm saying the public has never. The public has heard of Bank of America. They've heard of Wells Fargo.
BlackRock.
No?
I haven't heard of BlackRock.
The public knows Bank of America. They know Wells Fargo, Chase, Citi, Wells, etc. They don't know BlackRock.
They just made a major contribution to my the business school, the SUNY Albany Business School alumni. We just found out that BlackRock made a nice contribution to the school of business. So
That's good. I'm assuming from some of the research we've done, a lot of the same players who are executives in your traditional banks and the big banks that then wrote off these mortgages. Now
Sure.
they've gone to these other companies and are
Well,
taking it from the
absolutely
right
they have.
pocket to the left pocket.
Absolutely.
the players at Countrywide who were in Simi drove down the 118 to the 23 and they got off in Moore Park and they opened a PennyMac. Same guys, right? One West,
Yeah.
right?
Steve Mnuchin, yeah.
Steve Mnuchin, right?
Yeah.
Treasurer, Secretary of Treasury. He comes out of One West.
Yeah, you may not know one. Well, it was originally called IndyMac, a company that was so badly run that if you mention that to somebody who's had a mortgage through them, they shudder and cry. So they actually, what also happens in the banking industry a lot is they go, well, let's not fix the problem. Let's instead spend millions of dollars rebranding ourselves. There's a company right now that is rebranding themselves as, I think it's Mr. Nationwide. They're calling themselves Mr. Charles or something. Mr.
Nation Star
Cooper.
Mortgage
Mr. Cooper.
is Mr. Cooper.
Which is, they spend millions of dollars coming up with that, so we could all go, what the heck is Mr. Cooper?
You're going to make your payments to Mr. Cooper.
Mr. Cooper's foreclosing on my house. I mean, it's the dumbest thing ever. And the reason for that is because if you say Nation Star, which is a servicer, if you say Nation Star to anyone who's had the misfortune of having to deal with them, they will just go, oh my God. It's particularly funny, we have a lot of Spanish-speaking clientele, and it's particularly funny when we translate something and you hear the word Nation Star and the particular responses that come back and whatever the native tongue, it's hysterically funny. Because I've learned all the good curse words as a result of that. Because if you use these banks' names, that's what comes back. This is a common thing with the public, and unfortunately what happens over and over and over again, and one of the reasons I'm glad we're able to do this, is I cannot tell you the number of times I've had in my office, and I'm sure Lou has had in his office, somebody who comes in thinking, oh, I got this letter, I got this notice, must be something weird, I'll just go take care of it. And then they go, what? How is that possible? I haven't talked to these guys in a decade. I filed a bankruptcy. I got divorced and remarried, et cetera, et cetera. And how my life has moved on, how do I still have this problem? That's why I call them zombies, because they come back from the dead and they eat people's brains. They make people crazy. And that is also part of their business model, is to be so obnoxious to deal with. I had one bank tell me flat out, we strive to be so obnoxious to deal with, so horrible and difficult to deal with, that you would do anything to get us to stop calling. You'd rather deal with the devil himself than have to deal with us. That's their model. That's their admitted model. They're proud of that. And that's ridiculous. And it's insulting.
And isn't that too what I think I remember Steve you telling us was just that he at one point was like, just take the house. Like, I can't do this anymore.
Yeah.
I can't
Wow.
keep dealing with this.
Yeah.
And with his health declining the
Yeah.
way it did,
Yeah.
he was about to give up.
Yeah.
And that was when you swooped in and went to the rescue to save them.
They use frustration as a weapon. There's no question of that.
And now with values having gone up, whereas if these people had done Chapter 13s when the values were down, I could have stripped away the seconds, values up. Even if the property is worth $1 more than the amount owing on the first, I cannot get rid of the second. So, we struggle all the time to get values less than the amount owing on the first. That's becoming more and more difficult. And so if you cannot get the value less than the amount owing on the first, and you're in a Chapter 13 today, you have to pay on that second. And that second, all of a sudden, the original mortgage payments come back, and you may be sitting on, like we have one example, $200,000 in default interest and penalties that have to be paid over 5 years. It's impossible to do.
Yeah.
We're going to take a short break, come back, wrap things up. Your hometown station, AM 1220 KHTS. Carl Goldman here in the studio, along with Melissa Lampert, our KHTS Features Director, Richard Sherman, who's our Realtor Specialist, and Lou Esbin, our Lawyer Bankruptcy Specialist, talking about the second mortgage crisis and how it's impacting all of us here in Santa Clarita. We've given a number of examples as we've weaved through this hour. How widespread do you guys think this is in Santa Clarita?
It's bad. I've had, probably just in the last 2 months, I've probably had over a dozen cases that were just seconds, where people just were, I got this notice in the mail, I don't know what this means. Like, how can I have this second? It was charged off. And they come in with their paperwork and they're like, you see, it's just a mistake. It's just a clerical error.
Well, Well, let's tee it up statistically.
Yeah.
You have there's a very large percentage of the homes in Santa Clarita that had seconds. Okay, you either had an 80-20 split or you had HELOC. So who's at risk? Well, people who went through Chapter 13s and got through, they're not at risk. People who did short sales or were foreclosed, they're not at risk. Everyone else who, let's say, went through a Chapter 7, ignored the second, was fortunate enough to be able to ride through the recession, but now they've got an adjustable rate mortgage that may be adjusting, or they've
Or
got
those who went through loan modifications.
modification.
Also.
Yeah, so
also no problem
it's
then, yeah.
very difficult to tell how large is that statistical area, okay? But given Santa Clarita, which is pretty much similar to many other parts of the country, it's got to be a pretty large pool that I think we all are incumbent to reach out and touch and say, you got to be careful.
Yeah. Pretty much if you have a second, I would be concerned.
Yeah,
At the very least. There's actually this, I can't remember if I got this from Realty Track or who I read this from, but there's an interesting statistic. The number of notice of defaults, which is the opening salvo in a foreclosure, that are being filed on junior liens, meaning the first isn't attempting to foreclose, but a second or third or whatever, usually a second, is filing, is up tenfold. Not 10%, 10 times where it was at this time last year. So if that doesn't tell you, all you need to know, and I think California is number 4 on that list, if I'm not mistaken. But so what we're seeing is a lot of these seconds, it's just the equity position. A lot of these seconds just set a clock, and they waited and they waited and they watched their models and they watched their models and they realized, okay, nationally, or maybe if they're a little bit wiser, statewide or countywide or whatever, however their algorithm works, it's now time. And so they're coming out of the woodwork, and all of a sudden, these homeowners, there's a level of shock that they get, and it's awful, and we see it all the time to see them go through that. And you're seeing more and more foreclosures that are not based on the first. So that's the bad news. The good news is, you can work these things out. You just got to get ahead of it before it gets ahead of you. I mean, if you come in and you're 2 days before a foreclosure date, it's not impossible, but we got some serious problems.
And I think those foreclosing seconds are taking a look at historical data, and they're figuring we're starting to reach the end of this cycle.
Yep.
And they want to realize their position before the cycle comes crashing to an end. And they don't know when that is, but statistically, they're chart readers. They know that we're reaching the end of this cycle at some point, and they want to cash out on their positions and get as much money out of their collateral as possible.
How many of the banks that did loan modifications kept the second within the same bank? So in other words, if Wells or
very rare. Remember what I told you is that they split them,
right,
because they would treat it better under the law if they split them.
Yeah.
So very few of the seconds are accompanied with the first.
with the first.
Yeah, it's just a dishonest bargain. You get a loan from, say, Bank of America, and you get your first and your second from Bank of America because you like Larry at Bank of America on the corner. And what you don't know is Bank of America is going to sell that loan off to some third party who's going to sell that off to somebody else, who's going to sell it off to somebody else. And by the time you find out where the loan even lies, you're not dealing with the guy that you wanted to deal with. I can't go into the grocery store, decide to buy milk, and as I get to the checkout counter, they say, "Oh, I'm sorry, I ran across the street and got this milk. It's the same. Don't worry about it." Because the level of servicing that we see at these various banks is not the same. You may choose, you may go to get a loan and say, well, this Bank A and Bank B both have the same interest rate and the same cost. I'm going to go with Bank A because I like those people better and I choose to do business with them. Some people don't even understand that you don't even retain that right, because you may initialize your loan there, but they can sell it off to someplace else. And if it goes to Shell Point, who's been a popular bank for us of late, and what's funny about I'll tell you a quick Shell Point story. What's funny about that is when Melissa called him a second time, he didn't realize it was another file she was calling on. And I can only imagine, I wish I'd been there, I can only imagine the look on this poor guy's face, because he's responsible, he's the javelin catcher inside Shell Point. It's his job to take these calls and say, I don't know the money. And when we called in a matter of weeks with, here's another one, it must have been hysterical. Because, 10 seconds after he was off the phone with Melissa, he was on the phone with us, going, no, all is well, all is well. Please go back and tell KHTS all is well. Okay, well, send me documents and I'll be happy to do that.
I think the bottom line is, how do you reach out to the people of Santa Clarita and make them aware of a literal ticking time bomb?
Mm-hmm.
I felt like the village idiot the last time around, and he was standing next to me most of the time. because it was like, you can't continue to do this. And people are like, no, all is fine. And it wasn't.
As long as the values go up, it's not a problem.
Well, you guys continue to be diligent. I know Melissa will be on the hunt with you, Richard, as we talk through and look at other cases here in Santa Clarita and reach out to everyone to get a better handle on it. Thank you both. How do we get a hold of you, Rich?
To get a hold of me, and I should point out, everything I do, all the stuff we do with the loan modifications, rent seconds, all the stuff that I do, we do for free. So it doesn't cost you anything. Please give me a call. I'm at 661-714-1400. You can also get in touch with either Lou or I through KHTS. They have all of our stuff. But again, my phone number, easiest way to get a hold of me is just call me on my cell phone. I answer that number 24 hours a day. It's really not a problem. 661-714-1400. 661-714-1400. You can text me at that number as well.
Lou Espen, you have been a bankruptcy attorney here in Santa Clarita for many years and anchored in here, and as you said, one of the few specialists in the entire state. How do we reach you?
I can be reached at 661-254-5050. That's my office number, 661-254-5050. EsbenLaw.com is the website. Lewis@esbenlaw.com is my email. And I charge $100 for a consultation. You get a full hour of my time and usually follow up. And that's just so that there's some buy-in on both sides. But it's a bargain. And
It's worth it. Oh my God, is it worth it?
And I literally go through their situation, their facts, and if there's a time where, if it's a referral from Rich or Rich got to get involved, we work together on things.
Yeah.
Terrific. Thanks, guys. Melissa, I can't wait for your next story when you head out there and to see more incredible results as we've seen when we reach out to these lenders. You've been listening to a mortgage special. We'll bring you all back and do a follow-up in a few months.
Anytime.
AM 1220 KHTS, your hometown station.